Only 2 more bells until you can start your weekend. 30 minutes until the start of your cash equity trade. I'm Danny Berger.
I'm David Gura. Bloomberg Open Interest starts right now.
Coming up, the big tech divide. Amazon gains on robust results while supply shortages hit Apple.
A deal by billionaire Ken Griffin's Citadel with situational awareness caps a dramatic week for the AI trade.
And as markets head into August, earnings season passes the halfway mark while geopolitical risks linger.
Some stocks to watch. That big tech divide that we talked about just a moment ago in stark relief here as we look at the screen. Amazon reporting a 5th straight quarter of cloud sales growth with a 37% revenue jump for AWS. Should say it's a totally different story for Apple. Its shares falling this morning after it announced it has component shortages weighing on its forecast here in the quarters ahead, Danny.
Such big swings after reporting earnings we're seeing from these companies. I'm watching another sector that reported this morning, and that is oil and gas. A little bit less dramatic. Chevron reported second quarter results. Oil prices did surge, drew to war-driven supply disruptions. Exxon, they narrowly missed estimates. You can see they're down 1.33% for their profit forecast. That's what they missed on, dragged down by scheduled refinery maintenance. David.
Back to those undulations in the tech sector. I want to start with big tech. Apple sliding on a weaker sales outlook, while Amazon, as I mentioned, rallying after the company raised its AI spending plans. But Amazon CEO says demand still exceeds capacity.
We now believe we will spend approximately $220 billion in cash capex in 2026. The higher cost of memory pushing this number up from our prior estimate of about $200 billion. But even at that amount, we will still not have enough capacity to meet all the demand we have in 2026. And I believe this dynamic will also be true in 2027, too.
Joining us now is Bloomberg Tech host Ed Ludlow. Ed, great to see you. And I wonder if we could kind of start with this contrast that's kind of played out over the course of the week as we've made our way through much of the Magnificent Seven. What did those results tell you yesterday just about the way that Amazon's positioning itself vis-a-vis these other hyperscalers, big tech companies?
Yeah, I mean, look, Amazon completed the set of data points that Wall Street wants, the full flush to reward the stock, right? Which is demand is running ahead of supply. They are committed to spending. CapEx was higher in large part because the cost environment is higher. And then they offered more than just top line growth, more than revenue growth. So AWS 37% in the quarter gone, pretty significantly above expectations. But they said that there's already a return on the existing AI investment, which is the AI business for AWS has a $25 billion run rate. And the business of them renting compute capacity based on their custom silicon, principally their Trainium chip, also is at a $25 billion run rate. And if you are sort of thinking, well, Amazon, I know Amazon as Amazon.com. Well, there's something for you, too. They even said that people that have used Alexa Plus are more inclined to join Prime or spend more money on Prime. And they just kept giving additional data points that account for the stock being up more than 11% in pre.
Well, if you care about what the consumer side of the business looks like, maybe we can look to Apple as well, yeah. Ed. They reported earnings, a different situation there because they haven't been spending as heavily on AI, a disappointment. Where did Apple miss the mark?
So with Apple, not really, you know, an AI story or a spending story. It was astonishingly a management of the supply chain story. The quarter gone was good, largely a beat across the board, a miss in China, a miss on services. The issue for Apple is that the world is going to get more difficult in the September quarter than it is now. Memory prices will continue to go higher, and the revenue guide of growth of 9 to 11% was below what the street was hoping for, of about 12%. But astonishingly, what Tim Cook said in his final call as CEO is that they had got it wrong. They had misjudged demand, particularly on the iPhone side. And so if you park memory for a moment, they actually did not place orders for enough advanced processing chips, right? They got it wrong. And Tim Cook's career has been marked by his ability to manage the supply chain. So that's been really interesting. And look, the reaction of the stock being down almost 8% is quite severe.
It's a really good point, Ed. We've seen him, to your point, do things like change from the China supply chain to the India one quite adeptly. Ed, thank you so much. Looking forward to Bloomberg Tech, 11 a.m. Ed Ludlow. Now to a different side of tech, a dramatic unwind, specifically in the AI trade. The hedge fund Situational Awareness is scrambling after margin calls forced it to sell assets. They plunged from $45 billion to roughly $10 billion before Citadel's Ken Griffin swooped in to buy a bulk of the fund's public portfolio. Let's get more with Bloomberg hedge fund reporter Hema Parmar. Hema, you and the team doing excellent reporting when it comes to situational awareness. And I think a lot of people would look at this and say, okay, this is leverage in the system, and it seems to have come undone. What exactly happened with situational awareness, and where do we stand now?
Yes, this is a story we've seen time and time again. Dramatic couple of days, dramatic 24 hours. And, what happens is, this is what you see what happens when we see these firms which have huge amounts of leverage, concentrated positions in volatile stocks. And situational awareness had 4 to 5 times leverage on these assets. And this is what happens when those see a downward spiral. They need to meet margin calls. They need liquidity fast. They have to find a buyer. And they were seeking to sell their public stock book as well as their private stock book. Ultimately, they found a buyer in Ken Griffin's Citadel.
Talk a bit about the level of panic, so much as it existed here within the fund. So you've got this Wunderkind who studies math at Columbia. He's the valedictorian, goes on to found this fund. From your reporting and others, he was looking at Sand Hill Road maybe as a place that might take on some of this, of what's in the portfolio. Was there a lot of panic here? Sort of where was the head of the founder of this firm here as this all happened?
Yes, I mean, they were trying to find any number of buyers. So they were talking to Millennium, to Jane Street, to Citadel. They were in conversations with Green Oaks and Sequoia about the private book. So when you're looking to offload this degree of assets so speedily, it's not a good sign. It's problematic. And so I can imagine there would have been a great deal of concern. He's now reassuring investors to say, look, we made a mistake. We're trying to get back on track.
Leopold Aschenberg getting married this weekend.
This weekend,
as well.
Yes.
It's a tough time.
Talking about a stressful week.
Yeah. Some of his clients are probably in attendance, though, so I think he can get some work done.
Yeah, busy reception, no doubt. Hema, thank you very much. Appreciate that reporting. And I want to turn now to another story. A lot of earnings coming through this morning. Oil giants Exxon and Chevron reporting earnings before the bell. Maintenance costs brought down Exxon's profits, while Chevron beat estimates. Joining us now is Bloomberg energy reporter David Wethy. David, great to speak with you. And I think about these two companies and the amount of exposure that they have to the Middle East. It does seem like the story of these two reports, which were blockbuster, really are closely tied to what we've seen over the last 5-6 months in the Middle East. Talk a bit about that connective tissue between the war that continues with Iran and what we saw in the results today.
Yeah, it's baked into the DNA of these companies because it is such a heavy presence for them over there, and it's a constantly changing situation. It's hard for the executives to tell the street what to expect because it's hard for them to even know what the outlook is in the Middle East. And to that point, Exxon said that they expect that if the Strait of Hormuz remains fully closed through the third quarter, they said this in the slides for the call coming up, that they could see as much as 750,000 barrels a day of production offline for them. Right now, it's about 500,000 barrels a day that is offline as a result of the Strait closing. So they definitely like to see that open, and that would affect their production more. But particularly, it was the maintenance on the refineries that hurt Exxon this time around. It prevented them from being able to capitalize on the really high oil prices. But they said in the third quarter, they expect less downtime due to maintenance, so they should be able to capitalize on some of those higher oil prices.
Then what separated them between Chevron, who was able to capitalize on those higher oil prices?
Yeah, probably less maintenance than what Exxon did, or they were able to at least tell it better to the street so that there wasn't a miss. And so it was easier for the street to understand as compared to Exxon.
All right, David, thank you so much for joining us. That's Bloomberg's David Wethy on the latest big oil earnings. A check on markets 20 minutes to go until your trading day, your last of the week. And we're coming in from a huge session on the Kospi. We're rallied nearly 18%, but is still down 2% for the week. So the NASDAQ gets a bid, up nearly 1% after closing at its highest level in about 3 months. 10-year yields, those move higher this morning, up 2.5 basis points alongside Brent crude, up 1.5%. Some of the individual movers we're looking at this morning. Tesla is reportedly weighing a separation of its China business to pave the way for a possible merger with SpaceX. CEO Elon Musk calling the Wall Street Journal report, quote, fake news.
Shares of Moderna falling after the company said a key trial for its norovirus vaccine did not meet the statistical criteria for early success.
And we're also watching Jersey Mike. Shares fell 6% in their first trading day. The company raised $1 billion in an IPO that priced at the midpoint of its marketed range. And we're going to bring you an interview with the CEO next hour. I spoke to him yesterday, and he said, I promise our lettuce is not making you sick.
Coming up, we'll speak with TD Cowen's John Blackledge on Amazon's bigger AI spending plans and what's next for AWS growth. It's coming up on Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. President Trump says a U.S.-led board of peace has reached a deal for Hamas to disarm, calling it a major step toward ending the Gaza war. But Hamas says it won't give up weapons until Israeli troops withdraw, leaving key details unresolved and implementation likely months away. Novo Nordisk's push beyond obesity drugs hit a setback. Its experimental anti-inflammatory shot failed to reduce the risk of heart attacks or strokes in a late-stage trial, sending shares down sharply. The drug had targeted a potential $10 billion cardiovascular market. And FIFA's proposed $20 billion commercial spin-off is facing growing resistance from European soccer giants. Real Madrid joined other top European clubs in saying FIFA doesn't have the right to sell part of its commercial business. The dispute could threaten support for FIFA's Club World Cup expansion. We'll have more on that story in the next hour.
And Messi famously does not play in Europe anymore.
That's right, Miami.
He's in Miami. But certainly the other one does. Amazon surging after raising its AI spending plans and accelerating AWS growth. TD Cowen's John Blackledge boosted his price target, saying the results show AI investments are paying off. And he joins us now. John, great to see you. I mean, the fastest growth for AWS since 2021. How did Amazon achieve it?
Yeah, fifth quarter in a row that AWS revenue growth accelerated, and they called out, massive AI demand, so growth in AI revenue. Their AI business exited the quarter at like a $25 billion run rate, and they're also saying that the non-AI revenue growth is very strong. And I would also call out that aside from the revenue growth, which was great, margins expanded meaningfully and crushed consensus estimates. And they've been persistently high for now several quarters as revenue has accelerated. So that was really also great to see.
John, what do we learn about the future here? Management talking about $1 trillion revenue business over time. We know well the success of AWS for Amazon in not just recent quarters, recent years. What are executives thinking as they look at the inroads it seems like Meta and other companies have made kind of trying to get into this space?
Yeah, no, I think CEO Jassy was incredibly bullish and communicated so effectively last night. And you're right, he called out potentially AWS $1 trillion in revenue. If you go back to April to his shareholder letter, he was talking about AWS potentially doing $600 billion in revenue. So if we think about that over 4 months, you have that type of move. He didn't put a year on it, but it was incredible. And the other things that he was talking about were, AWS is going to be capacity constrained this year, 2026 and 2027, and that's on the AI demand. And then he said the AI demand in 2028, right, from what they're seeing right now, is striking, which we're a little over halfway through 2026, and he's talking about the demand in 2028. So it's just incredible. And I would also add that he reiterated that AWS's capacity will double by the end of 2027. So at the same time their capacity is doubling, the demand is so strong that they're going to be constrained through 2027. So all in, it's just off the charts demand. And we ended up materially raising our AWS revenue and operating income forecast next 5 years.
So ultimately, you had Andy Jassy communicating a very clear and strong narrative to this market. There had been this idea that part of the reason that Meta struggled after they reported their earnings is we didn't get that same clear narrative from Mark Zuckerberg. John, is there a contrast to be drawn between these two CEOs, not even just in the business, but their communication style to this market and what they're hoping to achieve?
Yeah, exactly. And I've covered both companies for a long time. And CEO Zuckerberg is a great communicator. Historically, he's been a great communicator. Historically inspires confidence within the investment community. But I feel like they've kind of missed the mark 3 out of the last 4 quarters. What we were looking for from Meta was some clarity on CapEx trajectory, clarity on monetizing excess AI compute, and then just more broadly, like they're investing a lot in this AI moment. What are the products and services and potential revenue streams out of that? And we didn't get as much as we would like, and it was disappointing. Kind of the stock disappointed after the reporting. But they do have an opportunity, right? Like CEO Zuckerberg was like, "Yo, we think we can sell our capacity at a significant premium to what we paid for it." And from a capex perspective, they were like, "Oh, we're going to maximize our capacity the next couple of years." So I feel like in the coming months we can hear more, and maybe they will cut some deals on Meta Compute. But to your point, yeah, CEO Jassy was spot on this quarter with his messaging.
John, let me ask you about prioritization. And our Ed Ludlow just a moment ago talking about how there was something in this report for everybody, even those of us who remember Amazon as a bookseller way back. It still has a very sizable, of course, retail component. What did you learn from Jassy, from the company, just about the way that they're looking at the conglomerate as a whole, the whole business, and how much they're prioritizing one part of it versus the others?
It feels like everything's firing on all cylinders, to be honest with you. We spend time on AWS. I thought they were incredibly bullish on the e-commerce business. I mean, they're at record delivery speeds, and I think they feel like there's meaningful runway for further, kind of improving delivery speeds. And in e-commerce, when you increase the delivery speed, you massively increase the conversion rate. So I thought that was really bullish for the e-commerce business in the coming years. Advertising growth accelerated. I mean, this company is firing on all cylinders, and it's a great question in terms of prioritization. And I think they are prioritizing their biggest bets, which are what we're talking about: AWS, e-commerce, advertising, among other areas.
I'm talking about India, Mexico, Australia as well for international expansion. John Blackledge of TD Cowen, thank you very much. Appreciate that update after those earnings. And coming up, we're going to speak with Baird's Will Power on Apple's supply challenges as we look at this contrast over the course of the morning. This is Bloomberg Open Interest. Apple slumping after supply shortages weighed on the company's sales forecast. Baird analyst Will Power reiterating his outperform rating on the stock, saying supply constraints pressured guidance, but demand remains strong. And he joins us now. Well, let me just start with what Tim Cook is leaving for John Ternus here as he looks to the exit. I mean, his last day is September the 1st, and we think of Tim Cook as having such prowess, such success managing Apple's supply chain. How much of what we saw in that report yesterday is attributable to kind of mismanagement on his part, or is it just by virtue of the fact that there is such widespread demand now for chips in particular? It's becoming increasingly difficult to manage, even for somebody who has been known for so long as somebody who can do it so expertly.
Look, well, good morning. Thanks for having me, David. Look, this is still a strong foundation, right? And I think, as you look at the results in the quarter, sure, they were a bit light of, expectations, or at least the upside that we've had, the past couple of quarters, and guidance might have been a bit light. But if you back out, some of the impacts from supply constraints and FX, the numbers actually look, still very good. And so I think, from our perspective, the demand signals continue to be, quite robust. And so I think the business remains on, firm footing as we head into this next 10-year.
So is it fair to say that Apple does not have a supply chain issue, that the shortage of chips and the cost of memory is something they'll be able to get through?
Well, without question, they're facing supply constraints, memory price issues that are, impacting, the broader industry. But I think that's something they'll work through with time. And so, our suggestion is that investors look through that. But sure, is that something that could create some turbulence as it has over the last couple of quarters? Yes. And I think that is something that will continue to impact both supply and, memory cost and margins as you look over the next, several quarters. But we're taking the longer term approach. And again, the key for us are the demand signals, which I think remain quite healthy. Look, we step back. iPhone, which is a mature business, has now grown north of 20% the past, 3 quarters. And you've also now got a, resurgence in Mac as well, to help balance that. A services business, that's a, $100 billion business, growing, low double digits. So, we remain comfortable with the overall opportunity moving forward.
So let me play this out here. You mentioned the Mac products, and if Apple's able to kind of wade through this 100-year flood, as Tim Cook put it yesterday, kind of ominously here, It released this MacBook Neo, this low-end product, and I'm curious sort of what your takeaway is from the reception that that's seen here over the course of the last quarter. I think that Apple for a long time was kind of pursuing the higher end of the marketplace. There was some resistance, I gather, from our reporting, Mark Gurman's reporting, to kind of going in that direction. But it does seem, from the results we saw yesterday and the demand that you've been talking about here, it is a niche that they are well suited to fill.
Well, I think that's exactly right. I mean, they had basically ceded share, to the Chromebook, market, and so Neo really opens up, a new opportunity for them, and they're going after that, right? And you're seeing that demonstrated in the numbers in the quarter with overall, Mac sales up, 27%. So again, really a nice resurgence there, and that's still facing supply constraints as well. That number probably would have been higher, without those constraints, and so. The combination of, Neo, Mac Mini, and then, of course, the broader, Mac portfolio, I think, sets them up well, certainly, medium term. Again, notwithstanding some of the supply constraints that we just touched on.
Even so, with some of those lower-end product offerings, they have raised their prices for their devices, some as much as 20%. Do we have any sense to the price elasticity among consumers, whether they are willing to continue to pay more?
Well, I mean, that is a great question, particularly as we get into the next iPhone cycle, because I think the expectation is we'll see, probably some higher prices, there as well to help offset, some of those supply and memory cost challenges. Look, our sense is overall demand is going to remain, fairly inelastic. Now, will there be some impact? Sure, there's bound to be, but that is one of the central questions. I think the results again that we're seeing at this point, particularly in iPhone, remain pretty encouraging. I think again the demand signals, have been strong, and we're going into a product cycle that we're excited about. I think consumers will be excited about with the first foldable phone and Siri AI as potential catalysts to help drive demand into the back half of the year.
Okay, Will, thank you so much for joining us. Appreciate your time. Will Power of Baird. Less than 4 minutes until your opening bell. We're going to speak with Amanda Agati of PNC Asset Management. That's after this break. This is Bloomberg. Let's get your Friday trading day started. You're watching Bloomberg Open Interest. I'm Danny Berger. A rebound this morning after the tech wreck of this week. We are still headed for declines on the NASDAQ, even if we hold this. But we did end at the highest level in about 3 months. Actually, 1% we should be able to end with some gains. S&P also higher this morning, too. And we got through the bulk of the earnings season. So we've digested a lot. Maybe smoother sailing. Maybe we'll finally get into the summer doldrums. Down at the New York Stock Exchange, Reformation ringing the opening bell. They listed yesterday and did their first day of trading up 0.5%. God, there's got to be a lot of pressure to dress really good for something like this. If you work for Reformation, which is literally a high-end clothing brand, they look pretty good, so I think it worked. Down at the NASDAQ, it is the Pat Tillman Foundation. They give support to vets and their spouses, and they're welcoming in the new class. So that's what's happening down at the NASDAQ. David, what are you watching this morning?
Yeah, love the sartorial commentary there. Again, watching these two major stocks here, Apple and Amazon. Of course, that's the contrast we kind of focused on over the course of the morning. Amazon reporting a fifth straight quarter of cloud sales growth with a 37% revenue jump for AWS. As we were just talking about a few minutes ago, completely different story for Apple. Its shares falling after component shortages weighed on the company's sales forecast. I think what's so fascinating here is the demand was there, as we were just talking about. People want to buy Macs, they want to buy iPhones, but Apple having a very difficult time getting chips. Kind of a similar story to what we heard from Qualcomm a little bit earlier this week. Danny?
So some big swings for them, a little bit less of a big swing for Big Oil, which also reported earnings. Chevron, they reported second quarter earnings. Oil prices did surge thanks to war-driven supply disruptions, so shares are up 1%. Exxon, though, even with that, they narrowly missed profit forecasts. They had an issue with scheduled refinery maintenance.
Putting a bow on big tech earnings, Amanda Agati, PNC Asset Management Group Chief Investment Officer, writing, you could say the Mag 7 band broke up. Google, Meta, and Apple get pummeled, while Amazon and Microsoft with big gains. These names are not trading like a herd or a pack any longer. And Amanda joins us now. Amanda, we're on the same wavelength. I was talking a bit about this yesterday, thinking about Michael Hartnett, who coined this term now many years ago, Magnificent Seven over at Bank of America. Talk a bit more about this. I mean, we talk about hyperscalers broadly now. They are approaching this CapEx expansion in decidedly different ways. And how useful is it for us now to look at them as one coherent group?
Well, it's always great to be with you. Thanks so much for having me. The AI story continues to be top of mind, certainly front and center for investors. But I think what's been different this earnings season is just what I wrote, right? The band is breaking up. There may be a reunion tour, so let's not give up on them just yet. But I think it's been very interesting that they are not trading and behaving in this sort of pack formation, right? With this herd mentality, there's been a really significant distinction between winners and losers. Why is that? Because the business models are different and the levers that each of them are pulling is very different. And I think in an environment where investors are getting pretty paranoid Android, that's a Radiohead reference for you. I think that's showing up here in terms of the results and certainly in terms of the return. So it's going to be okay, for sure. It's going to be okay. But in this moment where valuations are pretty elevated, the ones that are winning are the ones that have lots of levers to pull, are demonstrating acceleration in revenue growth, and still spending. CapEx is still a story, but they're kind of keeping it in check.
Loving this so far.
I say I've never felt more powerfully than today that we need more music on this show. Amanda, thank you for bringing it to us. Narratives are really powerful in this market, as you know very well. Having Mag 7 as this point of leadership for the market was something that really fueled the last leg of the bull market rally. What happens when that narrative starts to get complicated, when we don't know exactly who the new leadership or what the new leadership looks like? Is it just more volatility, more market churn?
Well, I think it's a great question, and I'm not particularly bothered by it, to be honest. I don't know if it's all the coffee I've had this morning, the songs, or what, but I actually would welcome a shift in market leadership. We've been talking for the last few years about how we can't hang our hat on one name. It used to be NVIDIA, and then the Mag 7, now it's the Lag 7, right? Like the storyline here needs to be a maturation of this innovation cycle. It can't be about chips. It can't be about semiconductors. It needs to be about the use cases. And so I would welcome a shift in leadership because I think that really means market breadth is becoming the more powerful story. We're figuring out how to use all of this technological innovation. I think that makes a huge difference in terms of the sustainability of the market rally.
I'm glad you brought us there because there's been such focus. Again, it's the immediate thing that we're looking at right now, of course, the Magnificent Seven, these big tech companies. But I wonder if you could kind of situate the results that we got this week in the broader context of the earnings season we're in the middle of. How part and parcel is it of that, and sort of what have we seen beyond the hyperscalers and big tech, and what did this week's results tell you about those?
Well, what it tells me is there's a significant amount of resilience in both the earnings backdrop and also the broader economy that I think is underappreciated by investors. We're so fixated on this paranoia around the top 7 names, but when you look at the run rate on earnings growth and it's not over, right? We still have a ways to go, but we're at like 47% year-over-year growth for the S&P 500 in terms of earnings this quarter. That's insane. That's a technical term for you. And this is the 4th quarter in a row where we have set a high bar and are handily exceeding it. And so for me, it's reinforcement that the underlying fundamentals are really strong. And even at these valuation levels, right, it's not a cheap market, but the earnings power has been so strong. We've actually seen some multiple compression this year. I think it's just a really strong setup going into the fall, despite some volatility probably creeping in as a function of the midterms.
Amanda, I hear you talking about fundamentals, and what keeps coming to mind is a conversation I had a few months back with a hedge fund manager who said, you, Bloomberg TV, and all of your financial media are covering markets wrong. You cover them every day like there's any rhyme or reason to it, but the world is awash in leveraged hedge funds, and that's all that matters for this market. That sort of idea has come even more into the fore with this 24-year-old fund, situational awareness, reportedly having to unwind. Amanda, I wonder if we look back at this market and see the huge run up in memory names, which situational awareness did own, and then the sell-off in AI, and then the rebound again yesterday. I'm looking at Morgan Stanley writing a prime brokerage note basically saying that it was hedge funds that were basically the sole buyer of stocks yesterday. If this is just a market that's getting bullied around by leverage and hedge funds right now.
Well, there's no question that the hedge fund community has changed the dynamics a bit as it relates to the market. And so, in an environment like we're in, where there's a lot of concentration historically, there's a decent amount of volatility, you really have to get creative about what the future holds for all of this AI innovation, robotics, automation, et cetera. It's not at all surprising to me that there are organizations out there, firms that are taking big bets on one side or another of these trades. And some of it's going to work out and some of it's not going to work out. But volatility and sort of the uncertainty around this innovation cycle comes with the territory. But I think from a long only perspective, there's just a really long runway here. And so if you can take a longer term view, but pick your spots carefully and use some of this volatility to your advantage, I think investors really will, win out in the long run here, staying the course.
All right, that makes me feel warm and cushy inside to hear you say that, Amanda. Thank you so much. So great to have you on this morning. Enjoy your weekend. Amanda Agati of PNC. Let's get a check on markets, and let me do the bad thing where I try to assign any reason to these moves beyond just hedge funds. We are up 0.5%. Again, I will point out Morgan Stanley saying that hedge funds were huge buyers yesterday, whereas retail investors actually sold a large amount, one of the biggest single-day selling on Robinhood's platform among retail investors. Just to give you a flavor of where we stand on this market. Amazon, after their earnings are higher by 13%. You can see a lot of the chip makers doing well today, carrying on from that South Korean session where we saw an 18% rally in just one day. That's not a weekly figure. Even so, down 2% for the week. On the downside, Apple, in terms of points being subtracted, is the biggest loser this morning, subtracting 54 points away from the S&P 500. Exxon and Linde also had earnings themselves, and that's also falling after disappointments there. Looking at the individual sectors and how they are performing today, consumer discretionary, that is doing well this morning, along with communication services as Meta rebounds. Materials, consumer staples, healthcare rounding out the bottom. So some of the safety sectors not doing well. Infotech only gaining 0.1% because Amazon is rallying. Yes, the chip makers are rallying, but having Apple not playing along is hurting that overall sector, David.
Appreciate it, Danny. Contrast in rhetoric and results, contrast in how they're playing out in the stock market today as well. Amazon, Microsoft, Alphabet doubled down on AI spending. More on this week's big tech results coming up next here on Bloomberg Open Interest.
The rebound continues with the Nasdaq trading at its highest level, or at least had its best day yesterday in about 3 months. The S&P only up about 0.25%. Let's see what the sell side has to say this morning with your top calls for some of the analyst action. First up, Wall Street reacts to a disappointing outlook from Roblox. BMO downgrades the video game company, cuts its price target over 50%. They cited monetization challenges and weaker than expected guidance. Shares getting punished this morning, down 26%. Next up, Wall Street impressed with Rivian's upcoming mid-sized electric SUV, although that's not reflected in shares this morning. Morgan Stanley says the R2 could attract a lot of buyers, but the company still needs to improve its production and lower costs. Baird sees encouraging early demand for the R2 vehicle. And finally, Wall Street focusing in on Apple's weaker outlook. Citi says services miss expectations. Evercore ISI points to strong iPhone and Mac sales, but slower growth in services. TD Cowen says higher chip costs and supply issues are the biggest risk right now. Shares down 9%, David.
All right, more on big tech now. Amazon surging after boosting AI spending, joining Microsoft and Alphabet in signaling that demand for AI infrastructure remains strong. Bloomberg tech editor Sarah Fryer joins us now on set here in New York. Sarah, I want to get to earnings in just a sec, but let's go to another story first involving AI, the Anthropic sandbox, where there's been jumping out of the sandbox into the sandbox. I don't know what the metaphorical term is here, but we're seeing sort of something similar to what we saw with OpenAI just a few weeks ago. That is, they had these models, they were testing them, and you correct me if I'm wrong, they kind of come to life, and the tests have gone differently than the company expected.
They were not properly contained in their digital box by the humans. It's interesting to me here that Anthropic is really blaming it on the humans, saying that their error in monitoring and the design of that sandbox is what may have caused this. That said, it does raise the question of whether this is the tip of the iceberg, whether, if this is happening with OpenAI and Anthropic, if it's happening with the other model companies too, how the government will react, and also, how did they not notice? Right? Until they did this investigation, they were not aware that this had happened. And so that raises a lot of questions. If you're running a business right now, if you're experimenting with models, you better be checking that they're doing what you ask them to do and nothing beyond.
The skeptic in me can't help but look at this and have two reactions. One, they want to prove, oh, it's not just OpenAI that has these really good models that have a life of their own. We have them too. But the second one I thought of, Sarah, was this letter that had been circulating around from Jensen Huang saying, we want open source here in the U.S. And Anthropic pushes back and says, government, you should really step in to be curbing the pace of AI advancements. Do you think there's a little bit of PR government relations happening here too, with them releasing to the world that this happened, kind of saying, government, if this is happening to us, we're honest with you. We can't say what the same would be for Chinese open source models.
There's a little bit of that, but remember, Anthropic's line for most of its history has been AI models are dangerous. You really need somebody who's responsible, who's going to look at the risk here and calculate properly how to build guardrails around it. Like that is kind of their thing, and it's a double-edged sword. It makes everyone feel like these models are above and beyond human capability already, and that we're just going to be like powerless to them in the future. And so we really have to think about it now, and Anthropic is the way to do it. It also ends up with situations like what we saw earlier this year between the government and the Mythos models, blocking it, saying you can't do that. So here they're saying it was the human error. To me, that signals that they want to indicate that their model, once it saw the open internet, the latest version said, "Oh no, I'm not going there. I'm not. Yes. I know I'm not supposed to do that." So I think they're trying to show the responsibility a little bit, even in the response to this. But of course, the incident raises all of these questions about how didn't people know? If Anthropic hadn't investigated this, would we even know about it? And who are those firms that were breached?
Two instances, not a trend make, but we got the same kind of introspective blog post from Anthropic that we got from OpenAI. And I'm curious, what happens beyond that? Is this leading to more government interest, maybe intervention? Does it lead them to take it more seriously, do you think?
I mean, we have Sam Altman in D.C. this week. Right. I'm sure there are many discussions happening about this. We have, IPOs on the line for these companies. They have to show this. As we have open source models from China, it's not clear that these, at least with these companies, we know that this is happening. This is like a show of faith, like we're disclosing this proactively because we are I think that's what this is about, really, is they're trying to get ahead of the government requiring that they investigate everything, by being proactive. We saw this a lot actually with like the social media companies, and we have transparency reports. We are doing internal investigations to take down coordinated misinformation. We don't need the government to tell us to do that, right? So it is a strategy in that sense, but I don't think that Washington's gonna just say, okay, well, that satisfies us. I mean, we'll have to see.
I guess with social media, though, I mean, there are some businesses that built themselves around social media, but there are a lot more businesses now that are adopting these AI models and have changed their business plans and their structure and their costs and their employees around it.
It's a lot more immersed in our economy.
Right. So isn't the risk that the government steps in and something gets shut off just much worse this time around because of the impact it could have on individual companies?
Yeah, and I think the scariest thing maybe isn't like cutting off these guys, because these guys do have political power that they've built up. But if the government says, you can't use open source anymore because we won't get that transparency about what's happening in terms of cybersecurity, well, the majority of businesses by token use are using those open source Chinese models. And so that would really harm a lot of businesses. At the same time, with these instances, you wonder if it's necessary. So.
Sarah, good to see you. Sarah Fryer here with us in New York, joining us on set. And coming up here, we're going to talk a bit more about South Korea, how its leveraged ETFs in sight as that country looks to curb volatility. That's coming up next on Bloomberg Open Interest.
Minutes into the last trading day of the week, we continue to rebound after the Nasdaq posted its best day in about 3 months. It's up 0.5%, supported by some of the earnings. I'll show you that in a second. Small caps having a more difficult day. That might be due to the fact that yields are moving higher today. Again, now up by 5 basis points. Really, since the Fed decision, we have seen some big swings in this bond market. No relief for the 30-year as it continues to trade at its highest the yield since 2007. Brent crude adds to that pressure, up at $90 a barrel. We had big oil earnings, Chevron, Exxon. Chevron able to capitalize off the high oil prices. Exxon is not, hence why you get that difference. Amazon, huge AWS results, their best since 2021, the revenue growth that they've seen. Apple, supply chain issues weigh on them after they report earnings down 8.5%. NVIDIA up 1.5%. SK Hynix, this is child's play. The fact that it is up 2.1% in the South Korean session, it was up by 26%. That was its best day ever. South Korean stocks in general, Kospi gaining 18%, huge moves. And that's part of the reason why South Korea has stepped in after a sharp sell-off. It was led by those AI chip makers, SK Hynix, Samsung Electronics. It rattled the country's stock market. The government now proposing new measures, including curbing retail access to leverage ETFs. Bloomberg Intelligence analyst James Seffert joins us to discuss. James, what are South Korean officials debating at this moment? What might they do to the country and ability to access ETFs?
Yeah, I mean, I think they're debating everything under the sun, trying to see whatever is within their purview to actually limit these things. One thing we know is they increased the size of your account limit, so you need to have a certain amount of money in your account to trade these things. That goes into effect, I think, this month, today, but potentially even. Another thing they're doing is they're going to limit the amount, like the portion of your portfolio that can be in these levered ETFs. They're looking to cap it at 20%. They're looking to require certain levels of education and showing that you understand these things before you can actually trade them. They want to increase the fees to trade these things. I mean, it seems like they're going to try everything they can to kind of put the lid on this leverage gambling fervor that they're facing.
James, kind of whipsawed here because there was such enthusiasm for these products early on. I'm curious, as we talk about SK Hynix's ADR here in New York, before that, I mean, this was the means by which U.S. investors, others could kind of get a piece of these South Korean companies. How did that shift? How did the terrain shift when we saw that ADR debut here in New York?
Yeah, I mean, I don't know if I'd say the terrain shift. I mean, obviously, it hasn't been a great thing since that ADR went live. But I would say that, like, when you look at these levered ETFs, for the most part, people were using ETFs in the U.S. to get exposure to these products. There was a few products like DRAM and a few other ETFs that you could get exposure, South Korea ETFs in general, because when you look at what these things were doing, SK Hynix and Samsung, initially they were 40-ish% of the underlying index. So it's not, people like to talk about the Mag 7 or whatever mangoes or whatever term you want to come up with the large stocks in the U.S. and say it's over-concentrated. In South Korea, 2 stocks at one point in June were made up 60% of the index. I mean, we've never even come close to anything like that here in the U.S. So you end up with these leveraged products that kind of go haywire. The traders start using them, retail investors get heavily involved, and things go crazy. And the ADR listing here in the U.S. just kind of, poured gasoline on that fire in some ways, you could say.
It doesn't help when there are stories in South Korea of retirees dipping into their pensions and putting them into leverage ETFs. And James, I wonder if for that reason, or maybe just a completely different market, a more liquid market, why we don't have the same conversations in the U.S., or maybe we do, about leverage ETFs and their impact on the market and what it means to retail investors. Have various regulatory forces also been looking at the huge amount of ETFs that have listed here that are leverage bets on single names?
Yeah, so the SEC has put out requests for comment on things that they're calling novel ETFs. I would say single stock ETFs fall into that. There's a lot of pundit worry about these things impacting the market. I have written notes that say there are instances of some of these single stock ETFs impacting the underlying, but usually in small and mid cap names. But nothing, it pales in comparison to what happened in South Korea. I mean, in South Korea in June, these single stock levered ETFs were the most traded ETFs in the entire market. That just doesn't happen here. Like, we're talking about tens of billions of dollars here in trading, hundreds of billions of dollars of trading here in the U.S. in these leverage ETF names. It still is not even coming close to touching, the money that we see trading in things like the S&P 500 or the NASDAQ 100 ETFs. So the size and scale of what happened in South Korea and the fervor with which it grew is nothing compared to what we're seeing here in the U.S.
James, insightful as always. Thanks for joining us, James Seffert. And of course, tune into ETF IQ on Mondays, 12 p.m. New York time. Coming up in your hour 2 of Open Interest, Paisley Nardini of PNC Asset Management. Plus, we'll bring you some of my interview with Jersey Mike's CEO, Charlie Morrison, after the company's trading debut. This is Bloomberg. We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger alongside David Gura. Matt Miller is still off as this market rebounds after the end of big tech earnings. Coming up, the divide among them. Amazon gains on robust results while supply shortages hit Apple.
A deal by billionaire Ken Griffin's Citadel with situational awareness caps a dramatic week for the AI trade.
And as markets head into August, earnings season passes the halfway mark while geopolitical risks still linger. We begin, though, with any moment now, economic data crossing the terminal. We should be getting final readings for University of Michigan consumer sentiment. It looks like those are just now starting to come in. With those numbers is Bloomberg's Michael McKee, our international economics and policy correspondent. Mike, what do you see?
Well, we see a little bit of additional confidence from the time the Michigan interim survey came out in the middle of the month. We're at 55.2 now from 54.4. Probably reflecting a little bit of the gas price decline, which is now going back up again. Now, the current conditions index is 54.8. That's a tick down from 54.9 and statistically irrelevant, we'll call it. Expectations do rise to 55.4 from 54.0. So the increase in the overall sentiment number driven by what people think is going to happen, and they're more optimistic about that. Now, the one-year inflation number is unchanged at 4.2%. The 5 to 10 year unchanged at 3.3%. So not a whole lot of change in the way people are looking at things.
Mike, we move from consumer confidence to the confidence of Fed policymakers and the central bank's path forward here. And we heard from those three dissenters over the course of the morning. Neil Kashkari among them, talking about wanting to see more incrementalism here in the fight against high inflation.
Well, now we have the third, Lori Logan of Dallas. She doesn't talk about incrementalism, but she does talk about modest action on rates, saying inflation will not reach the 2% target without further tightening. Labor, consumption, and financial market conditions indicate that monetary policy is not restraining the economy. Without any policy restraint, inflation will likely to continue to trend above target until there's an unanticipated shock. The FOMC cannot count on unanticipated shocks to achieve its goals and could always adjust policy if unanticipated shocks occur. Modest action in the near term would reduce the likelihood of needing to take sharper action later. Now, that last part is essentially what the message from Neil Kashkari and Beth Hammack was, is we raise rates a little bit now to counter the long-term inflation, and if for some reason we need to lower them, we can do that.
All right, Mike, thank you very much. Bloomberg's Michael McKee. And those hawkish sentiments might be part of the reason we're seeing yields move higher across the curve. 10-year yield now trading at its highest since January 25. 30-year yield now at its highest since July of 2007. Joining us now is Paisley Nardini, Simplify Asset Management Head of Multi-Asset Solutions. It's the irony of this bond market, Paisley, moving off the back of what we're hearing from Fed speakers after a chair, Kevin Warsh, saying we're playing the ball, not the referee. Connor Sen, a Bloomberg opinion columnist, put it thus: at the moment, Governor Waller and the regional presidents are in charge of monetary policy while Chair Warsh is doing task forces. Paisley, is this still a market that's putting aside Kevin Warsh and is now trading on what regional Fed governors are saying?
Yeah, I think at some point we have to find a way to glean information. So the data prints that are coming out, we think about employment data, we think about the inflation data. Warsh has reiterated that he wants his decisions and the committee's decisions to be data dependent. So we as the market are now going to place greater emphasis on those data points between now and the next Fed meeting, because that's all we have. I do think that he was quite vocal and that his approach would be a bit like the Greenspan era, less communication, less transparency. And we all know we've been really accustomed over the last 15 or so years to extensive transparency, forward guidance, the dot plots. And so there's going to be a little bit of a kind of environment where we have to adjust to this. And I think what we've seen over the last several days is the volatility that places in the market. And so that's something that we've seen really over the last 12 or 18 months that I think will continue. And that's what I think is the most important thing for investors over the next few months, is understanding the reality of the environment that we're in, and then how do you adjust your portfolio? How do you navigate these markets to ensure that you're not on your back foot?
I think this is such an important point because there's kind of a horse out of the barn-ness to all of this, that after Bernanke and Yellen and Powell, where there has been such transparency, to kind of go back to the Greenspan era seems so difficult. And it makes me wonder just sort of what this means for the primacy or importance of the comments that we're going to get from other policymakers in between meetings now. Yes, Kevin Warsh can have this goal of not saying much or not talking about the future, but it does strike me that you have a committee that he's going to try to wrangle here? Are we going to be obsessing even more now over the kind of speeches and interviews that these other policymakers give between meetings?
We will. And I mean, even after the presser this week, Warsh had said there was dissent at the table, and he's welcoming of these kind of conflicting views to arrive at the best decision.
The family fight, as he put it.
Yes, exactly. The family fight. But again, I think this just provides the market with everything it needs to know for right now, even though it is frustrating, right? That was kind of one of the main themes coming out of this week's meeting. A lot of investors were just frustrated that they didn't get more either policy decision or more transparency. But we are in the midst of, I would say, just change of leadership, not only at the Fed, but in the market as well. And that's where we're really seeing some of this divergence in some of these big tech names, the Mag 7. And that's, again, I think there's some rumbling below the surface that a lot of investors still haven't woken up to. We're still just looking at the market cap passive weighted indices and checking whether they go up or down every day, but not really understanding the drivers.
I wonder if we could almost put the two together. And this thesis came from the FT's Toby Nangle, this idea that part of what Warsh wants to achieve is he wants to get rid of forward guidance because that suppresses volatility. By having that forward guidance and holding the market's hand, guiding it to what it wants. When you have suppressed volatility, it allows both this economy and the market to take on more leverage. Paisley, I wonder if you could see a future in which there is more Fed-induced volatility, and that lessens some of what we're seeing in this market here, players taking on too much leverage and then big unwinds as a result of that.
I think we absolutely have seen this injection of volatility, and it's really been not in just the last couple months with Warsh stepping in. I think this was kind of the icing on the cake, not to frame it in a positive way, but the volatility that we've seen is we really had the baton passed from monetary to fiscal policy over the last several years. And really, the Fed's hands are tied. I mean, their mandate is to be data dependent. And I think many would argue that the data is showing inflation remains too high. But then they have the employment consideration on the other end as well. And so as an investor, you start to think, how can I navigate these markets? How can I prudently allocate across my portfolio? And there's a lot of ways that I'm hearing advisors and investors are doing so, whether it be moving away from market cap concentration into something maybe simplistic like an equal weight, or even starting to adopt active management again. I know that's kind of a bad word over the last few years, but we're seeing plenty of reasons as to why active management can prosper again. The increased market volatility, the divergence of the underlying securities, obviously lower correlation amongst some of the major stocks within the S&P 500. All of these give reason and rationale as to why the divergence can be capitalized on, and almost seeing it as an opportunity rather than a market risk today.
I want to ask you about the earnings that we've gotten over the course of the last week and what that's done, if anything, to kind of allay the generalized agita in the market about AI. So yes, we're getting updates from this handful of companies about their CapEx spending, but does it do anything to settle that question about the role that AI is going to play, the worth of that trade, the bet that these companies are making?
We've become comfortable with or accustomed to over the last few years of the rising tide lifts all boats. I mean, I've heard that over and over and over. I've maybe even been guilty of saying that myself because it's been true. I think what we've seen over the last couple months, and especially this week's earnings report across many of the major technology companies and communication services, is that the market is now really kind of understanding, is there disciplined CapEx combined with proven monetization? And I think that's the delineation now, is we're no longer just going to be playing this blanket approach. There's this change in leadership within the stocks as well. And as we all saw in the last few days here, Amazon and Microsoft were rewarded because in the case of Microsoft, spending and then monetizing that. And in the case of Amazon, through their AWS services, the profit margins on the cloud computing space are massive. And so the fact that they've been growing this consistently just shows, in addition to their kind of more fiscal prudency, that these two companies are coming out as leaders. And so I'm actually encouraged by the fact that the market is trying to now look through and understand that it is not a rising tide lifts all boats. And we really have to understand the drivers of this and if this can continue into perpetuity.
So as we start to look into active management, Paisley, I wonder if there's any lessons to be learned from situational awareness. The story du jour of a 24-year-old who starts a fund with fantastic results, betting all in on AI, then is forced to unwind as margin calls crop up, as selling an AI-related name crop up. Citadel buys it. There's market moves maybe off the back of that. I wonder if there's any lessons to be learned from that in terms of how the market has reacted to it and just asset management as a whole.
I believe there's a very important lesson, which is that sizing of your position, sizing of your bets matters more than the bets themselves sometimes. And so as we look at this instance that occurred this week, multiple times levered, very concentrated plays, the actual theme itself that was being expressed in the portfolio was not incorrect. It was the sizing of those positions, which kind of comes back to what you guys were talking about before I joined the show around just the markets in South Korea and the Caspian, and thinking about such a concentrated market and a lot of the margin accounts getting squeezed in that part of the world. And so ultimately, the lesson to investors is that after you've done your homework and your due diligence and you're putting on these position sizes, ensuring that you're being prudent in them, and so you don't have those types of catastrophic events for your portfolios.
Paisley, thank you so much for joining us this morning. Paisley Nardini of Simplify Asset Management. I think if you're going to learn a lesson, 24 is a good age to do it at.
Yeah, sure. I wasn't betting tens of billions of dollars, but it is a good age to do it.
It is a good age. Not many 24-year-olds are. Let's get a check on your markets this morning. We're about 40 minutes into your trading day, and the rebound has now turned into selling. We're down 0.4%. The S&P down 0.4. I will just point out that we are seeing a lot of names like CoreWeave are down. I got to say, some of the names that actually happen to be in Situational Awareness's fund are down. Nebius down 1%. Not saying that's the reason, but just want to point out a lot of those AI-related names.
Correlation, but not causality.
Exactly.
Yeah.
It could be related, but not saying it is. Basically, I'm trying to walk a very careful line. 10-year yields, they're also rising, so that's definitely not helping this market. Those are up 5.5% as Brent crude. That moves higher by 1%. Some of the single-name stocks that we're looking at this hour, Amazon reporting a fifth straight quarter of cloud sales growth with a 37% revenue jump from AWS. That stock seeing its biggest one-day gain since November 2022.
It's another story here with Apple. Shares of Apple seeing their biggest drop since April 2025. Supply chain issues, component shortages weighing on that company's sales forecast.
And Reddit plunging. Daily active users in the U.S. came in below expectations, which offset a strong third quarter forecast.
All right, coming up, back to situational awareness. Ken Griffin comes to the rescue after margin calls rocked the AI-focused hedge fund. Dig into that next. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. The Caspian Pipeline Consortium could vote today to halt oil exports indefinitely after repeated tanker attacks in the Black Sea. The pipeline moves about 1.8 million barrels a day, which accounts for nearly 2% of global demand. Oil prices jumped on fears of tighter supplies, especially for Europe. Anthropic says 3 of its AI models accidentally hacked real organizations during security testing because the test environment was not fully locked down. The company found the issue after reviewing over 141,000 tests, says the public versions of Claude were not involved, and is now tightening its safeguards to prevent it from happening again. And it is a dramatic unwind in the AI trade. Wunderkind Leopold Aschenbrenner's hedge fund hammered by margin calls, forcing billions of dollars in tech stock sales. The firm also exploring selling part of its prized Anthropic stake to raise cash, but scrapped those plans. And Ken Griffin bought most of its public stock portfolio, allowing it to keep its private AI investments. The photo of Aschenbrenner that you see here from the website for our posterity. Danny.
Do you think that he looks like Max Verstappen in that photo?
Yes, very true.
I don't know why that's relevant at all, but just came to my mind. Anyway, let's get more with Bloomberg Chief Wall Street correspondent Sri Natarajan about the things that matter and not what famous race car driver Leopold might look like. So can we just discuss how we even got here? How we got to a place where a 24-year-old had such a hold not only in the money he managed, but maybe the entirety of the market, that the machinations of situational awareness seem to have been enough to cause rallying and selling at this point.
And this is what we were just discussing, Danny. There are echoes of some things that are really new and part of this new modern financial markets ecosystem, and some things that are just as old as time. You have a 24-year-old who's gone through, after graduating from Columbia University as a 19-year-old, through the FTX world, the world of Sam Bankman-Fried, through OpenAI and had to be fired from there, and there was a contentious departure from OpenAI, to becoming the Nostradamus of AI, suddenly hailed as a know-it-all in the AI world. And then you have a situation where you have a hedge fund titan rising out of Silicon Valley. How often does that happen? That is all brand new, and that is all tied to this great giant AI trade that we've been in and we will be in for the foreseeable future. But the other parts, when you think about the fact that it was a concentrated book and lots of leverage, that's been a story for a very, very long time. The images that flash through your mind are Bill Huang, LTCM, go back over a century, and you have Jesse Livermore from before the Great Depression. So these things have been standard parts of the financial markets. These stories repeat themselves every few years, and that's what seems to be happening. Leopold had built up a great following with his picks. Every stock that he touched seemed to be moving higher, and as the markets turned, it left him in a precarious position because of the reliance on leverage.
There's a cyclicality to this. I imagine there'll be a lot of investors kind of looking at this, wondering what happened here. So you lay out his biography so masterfully here. But I would think that maybe if you were an alumni of the FTX world, as you put it, there might be some stink on you, but there might be people who want to have some aversion to doing business with you. I said this at the top of the show or before it began. How does a guy of this age, with this experience, amass the amount of money and investment that he did? How rare is that, and sort of what does that tell us just about the general marketplace here that he was able to do that?
But then everything in today's marketplace is rare and unprecedented and something we haven't seen before, right? Here's someone who, like, how many AI-educated natives exist out there? You won't find them in the crowd that's 40 plus. It is the younger folks who will be doing that. And this is someone who sort of started out in the OpenAI world, lived in that circle, lived in that group. He's getting married to the chief of staff at Anthropic this weekend. So you know that these are embedded folks who have been embedded in the growth of this AI world, and people who are trying to tease out where it goes. And if you go back to the fact that he wrote that big 2024 post about titled Situational Awareness that laid out the bull case for AI, it wasn't just about investing in the frontier models. It was talking about building out the AI infrastructure and the data needs and the compute needs and the power needs. And that was reflected in some of his picks when you go from SK Hynix to CoreWeave to SanDisk and Bloom Energy. So broadly, it made sense. It's the financial machinations that ended up not making sense for him. And that's why he was sort of in this situation where now it seems clearly badly bruised, not necessarily beaten, because you have to remember he emerges out of that still in the vicinity of roughly $10 billion in assets, maybe a little bit more. After this rabid run of headlines over the last 24 hours, here's a hedge fund that's still up roughly 80% year to date. That's called one of the best performing hedge funds of the year if you ignore the last 24 hours.
So it was another kind of Substack success story, reminding me of the Post that that's how he made his name.
Yeah. It's a powerful medium, and for what it's worth, a lot of the stocks he owns, according to the last filing, which I know isn't since the end of the first quarter of March, are selling off yet again. But if you just kind of track the stories about him in this market, I think it's a really interesting exercise, because you have the story of his huge returns, and at the same time, you're having this huge run up in things like memory stocks applied to AI. And as the market starts turning, you see things start to snowball. And I wonder how much of that is looking at that portfolio and saying, this kid is about to get some margin calls. He's very, very leveraged. I'm going to sell my holdings and get out in front. I just wonder how much of the market dynamic is dominated by hedge funds behaving that way, and pod shops, what name you, situational awareness itself. How much of that is pushing around what we're seeing day to day?
Vulnerability begets vulnerability. This had all the hallmarks of a classic bank run. These are not points that I'm making. These are things that Leopold wrote in a letter sent to investors late last night. So clearly they seem to feel there were many people in the market who were positioned against them, and that sort of amplified their problem. That certainly was the case. But on the other hand, you can also make the argument the only reason he was up so much, 270% through late May, potentially in the range of more than 400% through late May, was for the same reason. The stocks that he was betting on, that everyone was following him on, was also going up for the same reason. So you could have expected this to happen.
He's on the phone with Sequoia. He's going hat in hand to banks within a half-mile radius of where we're sitting today. How did he end up in touch with Ken Griffin? What do we know about the way in which they got in touch and why Griffin was interested in this?
Again, in terms of absolute granular detail, we still don't know a whole lot, but it is clear that going into Wednesday night, this was an all-hands-on-deck moment. They were trying to figure out what is the best way to raise money. Remember, so far, we haven't heard of any banks having suffered losses. This is very different from what happened with Archegos and Bill Huang in 2021, which basically wiped out Credit Suisse if you had to extrapolate what happened there. In this case, the banks haven't lost money. The sense we are getting when we talk to bankers and his various primes is, in the last several months, they had been tightening their margin requirements. They had excess cash from him that they could call on, and that's what they did. They didn't lose money, but it still meant that situational awareness, the firm had to raise money to meet these calls, and they were looking at all options, potentially selling their private stake, potentially selling a good chunk of their Anthropic stake, which has gone up in value so much. But ultimately, they decided to sell a big chunk of their public equity portfolio because they got the right kind of bid. We know Millennium was looking at it, Jane Street was looking at it, but at the end of the day, it was Ken Griffin's Citadel that came through. And this is not a first-time play for Ken Griffin and Citadel. They did it back before the financial crisis with Amaranth, with Sowood Capital, that distressed credit fund back in July 2007. We saw shades of that during the Melvin Capital disaster. So this is a tried and tested strategy for Citadel. It seems to work really well for them. And in this case, it might have actually helped what was looking like a mediocre July for them turned into something much better.
I just hope Leopold has a good wedding planner, because that man is doing no work getting ready for this weekend.
One thing you can be certain of is he won't have to skimp on the shrimp cocktail.
There we go.
This is a great point, Sri. Thank you so much for joining Bloomberg Sri Natarajan. Coming up, we're going to hear part of my conversation with the Jersey Mike CEO. An early rebound this morning turns to selling for this market as the S&P down about 0.25%. The Nasdaq not faring as poorly. The Russell 2000 is down 1%, which might give you a hint of why we had this turn. Perhaps we felt confident that Ken Griffin was stepping in to support this equity market. Buying situational awareness is fun. However, now yields are moving considerably higher, about 5 basis points for the 10-year yield. So we reignite the pressure on this market. So a lot of those names that got relief are selling anew. Apple down 9% after their earnings. Amazon up 15% after their earnings. 2 earnings from Chevron and Exxon, and Novo Nordisk missing on a clinical trial. Coming up on the show, we're going to hear from the Jersey Mike CEO. Fresh off of its $1 billion IPO, Jersey Mike slumped in its trading debut. Shares fell by 6%, but are trying to rebound this morning, now down for a total of 3.33% over the past 2 days. I spoke with the company's CEO, Charlie Morrison, on the floor of the New York Stock Exchange yesterday.
I think it's a great time to IPO Jersey Mike's. This is a brand that's been built over many, many years. We have a rich history of over 70 years. The last 20 years alone, the only brand that can cite 20 consecutive years of positive same-store sales growth. We've been able to navigate the choppy waters over many, many, many times through our cycle. Even this year, year to date, same-store sales continue to grow. We've seen sequential improvement from quarter 1 to quarter 2, exiting quarter 2 at 2.3% same-store sales growth. Most of that driven by traffic. So it's a great time to bring this brand to the market. We can deal with some of the challenges that are in there, but really it's for the long term.
So the fundamentals look good heading into this, but was there ever a banker that was thinking, hey, Charlie, maybe now's not the time, maybe we need to wait for calmer waters?
Not at all.
They told you full steam ahead?
Yeah, this is a brand that's really well built for the public markets.
What about the pricing? Because shares have fallen, initially down 8.7%. They've come back, of course, now down only about 4%. What do you think of the pricing? Was the pricing off perhaps, and that's why we're falling? Today, maybe valuations a little bit too richly priced, rather?
No, I don't think it has anything to do with the pricing. I think the market's been a little choppy over the last few days, trying to find its place. Again, we're not looking at today's price. We're not worried about this. We're worried about the long term and continuing to do what we do well, which is grow restaurants, grow our same-store sales growth, continue to deliver great value for our shareholders, and we know they're going to win over the long term.
Let's talk about the long term, because now with IPO proceeds in hand, what do you want to do with them? What are the opportunities for growth that you're going to be pursuing?
Well, I mean, we're a brand that is an asset-light model, so we're 99% franchise. We generate a lot of cash. We carry some debt. We're using the primary proceeds just to pay down our debt a little bit, so we get down below 4.5 times our EBITDA, and that's okay. Over time, we really will use our cash to return that capital back to shareholders, which is very much the common practice in a business like ours, and that'll be the continued pace over time.
I know one of the growth strategies that you're pursuing is international expansion. You have big plans for the UK specifically. I know the market. I lived there for a while, for about 6 years. They do eat at Subways, so they know sandwiches. sandwiches. Quality might vary there, but they love like a Tesco's meal deal where they get, a sandwich and a bag of crisps, as they would call it, for £4. How do you convince them, and how are you certain that a British audience would like a Jersey Mike's?
Well, we know people all over the world enjoy sandwiches and sub-sandwiches. Certainly the market's been well established. What they don't know is the authenticity of how to really deliver a deli-style sandwich the right way, the way we do it here at Jersey Mike's. That's been part of who we are for the last 50 years. It's exactly what we're going to bring to the UK. We're going to bring the brand in its full force to the UK. And look, we have a hot sub option as well. So our cheesesteaks, our hot subs, other products will be anchored on the menu. And we're going to do it in a high quality way. People want that kind of quality and authenticity.
Anything
Not
new for
really.
the Brits?
I mean, one little thing maybe, we might bring salted beef to the protein mix and lineup. We know that's a big fan favorite overseas in the UK. And so you might see that change, but otherwise it's going to be authentically what we've been all about at Jersey Mike's.
I also love this subtle dig of they know subs out there, but like maybe not the real deli style. Charlie, elsewhere, here in the US, there has been this real concern about the outbreak of Silospora and the concern about iceberg lettuce. I know a lot of the majority of Jersey Mike's subs use iceberg lettuce. Is your supply chain affected at all?
We are not. We're not affected at all. In fact, we do buy whole head iceberg lettuce, but we buy it from primarily Salinas, California this time of year, none from Mexico. We actually take very good care of that product. We bring it in a whole head fashion. We peel the outer leaves off, wash it carefully, and actually shred it for our customers right there. And so we don't see any risk associated. That hasn't impacted our business.
It maybe hasn't impacted your supply chain. Chipotle said the same thing. We source it somewhere else, but yesterday they pointed out it has impacted sales because the psychological concerns. Are consumers pushing back? Or maybe at least not asking for lettuce on their sandwiches?
Well, every one of our sandwiches can be customized because we make it to order right in front of you. And so if a customer wants to opt out of the lettuce, that's fine with us. We'll accommodate that.
Have they been?
And not really. I mean, we've been eating them for the last 2 weeks on the road. We've been enjoying them. I think customers understand that the supply chain moves very quickly. The product's probably out of the supply chain and everything's fine.
The credit card and debit card data that the Bloomberg team tracks does show a little bit of slowing in July for Jersey Mike's. Certainly still growing, but a slowdown in that growth. What accounts for that then if it's not the lettuce of it all?
Well, I think there's a lot going on in the marketplace right now. I wouldn't look to any 1 or 2 weeks as indicative. Lots of things kind of ebb and flow, and too often you can get too much data that'll point to two different things, but right now we haven't seen much.
So summer sales have been strong, maybe besides a little bit of July?
Yeah, we haven't talked about anything about this particular quarter at this point. We certainly saw strong performance in the first quarter, sequentially improving in the second quarter. We exited the second quarter on a strong note as well, and so we're going to continue to play our game and execute a game plan that is going to drive long-term sustainable same-store sales growth.
So I hate to do this to you, and I hope you don't check your social media mentions, but if you just look up Jersey Mike's, there is just a wide swath of people who say, oh, since the Blackstone PE overlords came in, they've changed the sandwiches. They have, shrunk in size. People love to complain that like PE comes and ruins their favorite sandwiches. Charlie, can you say here definitively, have the sandwiches changed at all, quality or otherwise?
Not at all.
Since you came into the helm?
Not at all. That's just hype in social media. They like to pick on people for that reason. We haven't done nothing. I mean, I've been involved almost as long as Blackstone has. We haven't changed a thing. Why would we? This brand has grown 20 consecutive years, positive same-store sales growth. We don't need to change the menu. We enjoy one of the lowest food costs in the industry. Our franchisees have some of the highest cash-on-cash returns in the industry. They want to grow and build more stores, and they're going to do that. And so no need to change anything. We love this brand. We love the way we deliver the product, and we're going to continue to do it that way for a long time to come.
On the cost, because generally this market, if you track the macro data, things like dairy, meats, the prices have been rising. Mm-hmm. How have you been accounting for that? How do you keep your margins?
Well, we have a very diverse lineup in our menu in terms of the proteins that we offer. So beef, chicken, pork, different products all within our menu. And we're able to balance that over time. So as one is high, like beef prices today, we focus on other parts of our business. And we've been able to maintain that over time. We also have a very scaled supply chain. Over 3,000 restaurants strong. We buy in very high volumes and are able to hand that back to our franchisees in the form of a very low food cost, around 27% of sales, which is industry leading.
How about prices? sandwiches. Are you able to use that as a lever to charge more prices for higher prices for your sandwiches?
Certainly over time we do take price. Our long-term algorithm is low single-digit same-store sales growth for this business. That will be equally balanced between price and transaction growth. We err towards transaction growth. That's really how you grow the health of the business over time. We've taken some price as we've seen commodity inflation, not nearly as much as some other brands, and that, quite frankly, is what's been fueling our growth this year and years prior compared to the rest of the concepts out there.
Part of my conversation there with the Jersey Mike's CEO, Charlie Morrison, the shares did ultimately end down. A lot of the trading community just pointed to the fact that they priced at a really rich premium. Wingstop, which he used to run, their valuation was about 2 times as much. But I mean, you just hear the CEO, he's very confident. We haven't been hit by the lettuce. Everything's fine. We haven't changed the sandwiches. So why not price as richly as they did?
We can talk about the debut more, but I have to ask you about the salted beef. Do you think that's going to be successful?
So usually
this is a popular.
It is, but not in sandwich form. They usually eat it in a bagel form, which I have a lot of opinions about because their bagels are disgusting. And I'm going to get angry mail from Brits who are watching this right now. I don't know. I can't see people eating a salt beef. They're cold, by the way.
Okay,
so they're a cold
hot
sandwich of roasted beef smothered in bright yellow mustard. So maybe, I don't know. I wouldn't eat it.
Going back to the debut itself. Your sense of sort of we're going to see more debuts like this going forward? We were talking about it yesterday. We've had these kind of big tech IPOs thus far. SK Hynix, ADR. I mean, this is like a departure. This is a very consumer-focused company.
We saw Reformation yesterday, too. They had a little bit of better success, only up 0.5%. But I think Bailey put it well, Bailey Lipschultz, our IPO reporter, that there is this slim window of getting out before we have a summer lull. You want to get out into the market, and especially if you're private equity and you've had a CEO in the form of John Gray who says this is the year of the IPO. Jersey Mike's, of course, Blackstone-backed. You want to show this market, yep, it's the year of the IPO, so we're going full force ahead, even though we have seen a lot of the restaurant category stocks falling this year.
His comments to you about the sandwiches not changing, getting a lot of traction. I mean, I haven't eaten there enough to know the contrast. Like, I've had subs from there, but I couldn't say definitively, have they changed?
This is my problem, too. I couldn't come in with scientific evidence.
Couldn't push back.
Exactly, which is...
you could push back, but you couldn't push back with, like,
exactly, which
knowledge.
shame on me, because as a journalist, I should have done my due diligence and eaten as many Jersey Mike subs and subs in general as I could before this. But social media is lit up off the back of these comments, and the majority of them, because people who comment tend to be angry, are saying, I sure trust the PE guy who says that PE makes no difference at all.
This is when I miss Matt Miller and feel like a poor substitute, because I think like he knows them all by number. Like, he's a real, I think, devoted Jersey
and be
Mike's
like,
fan.
I want that with Mike's Way, which is, I think, vinegar and
Stuff,
oil.
Vinegar
and oil instead of sauce.
Messier. I want a messier sandwich.
Exactly. Who doesn't want a messier sandwich? Back to the markets,
right.
A departure from sandwiches this morning. Let's just take a look at where we're at this moment. We're off the lows this morning. The S&P little change. The NASDAQ goes back into rally mode, up 0.1%, a really volatile market. 10-year yield certainly not helping, up 5 basis points as we get the dissents dripping in from the 3 different regional Fed governors, and Brent crude up 1.2%. Some of the single stocks we're looking at this hour, Chevron reporting results as oil prices surged into the second quarter while maintenance costs dragged down Exxon's profits.
Look at the pharmaceutical sector. Moderna is saying a key trial for its norovirus vaccine did not meet the statistical criteria for early success. It reaffirmed its earnings guidance.
And another drug company, Novo Nordisk, slumping after its experimental drug failed to reduce the risk of heart attacks and strokes. It's a blow to the drug maker's growth prospects beyond obesity and diabetes.
All right, coming up here, oil moves higher after Iran said it stopped 6 tankers in the Strait of Hormuz. Dig into that next. This is Bloomberg Open Interest. Brent moves higher after Iran said it stopped 2 tankers and forced 4 others to change course in the Strait of Hormuz. Want to get the latest now from Bloomberg Washington correspondent Tyler Kendall, who is at the White House. Tyler, we heard from the president this morning talking about the war in the Middle East. Just going to quote a bit from an interview that he gave to Fox Business a little earlier today. He said, quote, "It's going well. All you can do is keep winning, then eventually something will happen. We're hitting them hard, knocking them out for a loop." So we saw on Wednesday the president making good on his promise that he would do that. We saw those attacks. I'm curious what's developed since, and you see this news from the IRGC that they've stopped these ships and diverted a few others or caused a few others to go in a different direction here. What is the state of play here on this Friday?
Well, David, at this point, it feels like we're in a cycle of escalation when it comes to retaliatory strikes, and Iran really giving us no public indication, at least, that they're willing to let up their leverage when it comes to the Strait of Hormuz. Iranian state media characterizing these vessels as violating tankers because they very likely were using that U.S. coordinated route that hugs the coast of Oman instead of that corridor that would get them closer to the Iranian coast. And we have this statement from the IRGC saying that it has advised all companies and insurers to, quote, ignore CENTCOM's announcements. Now, we have to keep in mind that earlier this week, there was a proposal put on the table by Oman that had said that both countries could share equal jurisdiction over the Strait of Hormuz by utilizing that so-called middle passage, but Iran ultimately rejected that. Now, we can say there's been some positive indications in the data, at least when it does come to commercial flows, though it has remained effectively stalled. But Bloomberg News is now reporting that what's known as oil shuttling has picked up in recent days. Our analysts say that this is incredibly significant because it had really fallen amid the escalation. But this is when vessels turn off their transponders and they essentially ferry supplies through the strait and then load them up on vessels that have been waiting outside of the waterway to then load up those cargoes and continue on their way. David, perhaps we heard this tough rhetoric from President Trump earlier today because just moments ago he lifted off here from the White House on Marine One on his way over to Camp David. He's accompanied by his Secretary of State, Marco Rubio, and Secretary of Defense, Pete Hegseth, because they are going to convene a cabinet meeting at Camp David later today for a status update on the conflict in Iran.
To what degree are there conversations about military support of getting ships through the Strait of Hormuz, and perhaps not just in the U.S., but before there have been conversations of Europe doing the same as well? Tyler, have there been workarounds over the fear that they might get struck by Iranian drones, what have you? Is the U.S. stepping in to support vessels?
According to CENTCOM, Danny, they are continuing to escort ships, but now we're seeing that there is this sort of butting of heads, if you will, in the Strait, with Iran saying that these ships should not listen to CENTCOM's orders. We did see earlier this week that Saudi Arabia came into the picture in perhaps a much stronger way than we previously saw, saying that they had convened this coalition for a potential maritime coalition of other allies that could maybe help lend support when it comes to the Strait of Hormuz. Though so far, we've really seen that regional allies and European allies in particular have been wary when it comes to the president's calls to help deploy assets to make sure that the Strait can remain safe for transit. We'll have to see where it goes from here because it's not just the Strait of Hormuz that's seeing these disruptions. Of course, we've been tracking very closely the threat from the Houthis in the Red Sea, which caused Saudi Arabia to reroute those vessels to the Mediterranean coast of Egypt, which earlier this week saw at least 2 tankers hit off the coast. We still haven't gotten a group to claim responsibility for those attacks, but of course just lends to the broader picture and heightened tensions in the region.
Tyler, have about a minute left. In the middle of all of this, the president drawing attention to another conflict that's still very much roiling in the Middle East. That's what's happening in Gaza. And the president writing on Truth Social today, the Board of Peace reached an historic agreement for the complete disarmament of Hamas and all other armed groups in Gaza. This is, as he put it, a monumental step toward lasting peace and security. That's the post. That's the social media post. What is left unfinished here? Still a lot of disagreement, it seems, between both the Palestinians and Israelis on this front.
Well, David, if the agreement holds, it would be a very significant step in that 20-point peace plan to end the conflict in Gaza after months of really little progress. But it's unclear exactly how this is going to work. It hinges on Hamas giving up its arms, with a senior Israeli official saying that Israel is also demanding that there has to be a complete demilitarization of the Gaza Strip. Once that happens, then Israeli forces would withdraw. But to your point, we're already getting conflicting signals that there may be differing opinions on exactly how this sequencing is going to work, because David and Danny, Hamas did come out and confirm that it did strike a deal, but their officials are saying that they are not going to take any steps unless Israel withdraws its troops first.
Tyler, great to speak with you. Thank you for that update. Tyler Kendall there reporting from the White House. And you can catch our conversation with former U.S. Ambassador to Israel, Thomas Nides, along with former U.S. Ambassador to Ukraine, Bill Taylor. That's taking place on Bloomberg this weekend, 7 o'clock Wall Street time tomorrow morning. Coming up, FIFA creating a battle off the pitch just as intense as the games on it. More on its spin-off plans next. This is Bloomberg Open Interest.
The backlash to FIFA's spin-off plans continue. Juventus, Real Madrid, and other clubs say that FIFA lacks the authority to sell shares to outside investors. Europe's football governing body, UEFA, says its members will boycott all FIFA tournaments. For more, we're joined by Bloomberg sports reporter Ira Boudway. Ira, who is protesting this at the moment, and will they have any ability to sway FIFA or get them to back off of these plans?
The biggest protest is coming from UEFA, the 55 member associations from Europe, who have come out and said they will not participate in any FIFA competitions, which would start with next summer's Women's World Cup in Brazil, include the Men's World Cup. Without Europe, I mean, we just saw Spain win the World Cup. They've won 7 out of the last 10. Without Europe, you don't really have a World Cup. Since then, we've seen CONCACAF, which represents North America, Central America, the Caribbean, has 35 voting members, come out and say they reject this plan. The Asian Federation the Asian Conference has 46 members. They've said they reject it. That's enough to lampoon it. There's 211 members. More than half now have come out and said they're against it. However, how members actually vote when the day comes, FIFA says they're going to continue a consultation process, and the vote's not set to happen until September 19th, so there could be some twists in the road.
Talk to me about Gianni Infantino, ubiquitous at the World Cup. At every game I seem to watch. He's up for re-election, going unopposed. Talk a bit about that. I mean, there's been a lot of reporting over the many years on FIFA and the way that it's governed here, but talk about the hold that he has on this organization, the confidence that he has that he can get something like this through.
Yeah, it's pretty spectacular to come off of this World Cup, which was a massive commercial success, arguably the biggest sporting event in the history of the world, made about $10 billion in revenue. He comes off of that, and looks like he's going to cruise to re-election in March, and then just this week says, I've got this plan that he, according to a lot of the federations, he never told them what he was up to. He was talking with JP Morgan Chase and others in the background, comes out with this, and now it looks like he could be in real trouble. I mean, the way it has traditionally worked is FIFA parcels out money from all that $10 billion from the World Cup and so on is parceled out to the 211 member associations. And as long as that spigot continues to flow, they continue to support the leadership. But now with this mutiny on his hands, it's really going to be interesting to see if he can hold on.
Again, it's always important to reflect back on the idea that FIFA is a nonprofit, and that's how this organization is set up. Even so, you saw a World Cup with an expanded tournament, more teams coming in, thus more games, and Infantino talking about doing even more in the next World Cup. You had hydration breaks, which he said it was to protect the players, but allowed them to conveniently run ads during it. To what degree is sort of the charade of nonprofit sort of falling by the wayside, that this is an entity that is making serious money and becoming commercialized by the tournament?
Yeah, it's interesting that I spoke with somebody who used to be in governance at FIFA and said that basically the way to think of this is a multinational corporation with a monopoly on football. And so they can kind of do what they want. It was already moving, as you say, in a direction of profit maximization. This move to bring in private investors is really just turning up the dial on that, allowing them to cash in on that. But that seems to be a step too far, at least for some members. So it's possible that Infantino has sort of overplayed his hand here. But even if they don't go forward with this, you will continue to have a framework where the real business of FIFA is putting on these lucrative international tournaments and then sort of is parceling out the revenue to its membership.
All right, great to see you. Thank you for the update. Ira Boudway joining us here on set in New York. And now take a quick look here at what's ahead for markets in the week ahead. On Monday, we're going to get earnings from Palantir, along with ISM manufacturing data. On Tuesday, SpaceX set to deliver its first earnings report, and we're going to get results from AMD as well, plus JOLTS and durable goods numbers. On Wednesdays, earnings from Disney plus ISM services and ADP employment data. Thursday, Warner Brothers Discovery earnings and another round of jobless claims. And then on Friday, the much-awaited July payrolls report, of course, in light of what happened this week, Danny, with the Federal Reserve, the importance of this data even more paramount than it usually is, and I know will be closely scrutinized by policymakers.
It will, although this is a Fed that sort of emphasized the problem is not employment right now. It is inflation. We care about PCE, but maybe next year we won't be using PCE as the measure.
We'll see what the task force says.
I personally am really interested in what Warner Brothers has to say in their earnings, because the Skydance Warner Brothers Paramount deal has now been put on pause until next year as these court cases start to happen. So
paying a sizable monthly fee all the while.
Oh yeah, the Ellison's on the hook for quite a chunky change, and I'm really excited for this weekend. What do you got on deck?
As I said, Tom Nines is going to be there. A good focus on geopolitics, but of course, given what we saw over the course of the week, plenty on markets and the economy as well.
Thank you so much for joining me.
Thank you for having me.
Really fantastic to have you. That is Bloomberg Open Interest. Enjoy the rest of your Friday.